Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And I know you're going to get tremendous value from the gentleman we're interviewing today. His name's JC Castillo, and JC has done, bought and sold over 1,000 doors. His current portfolio exceeds $50 million. And we're just lucky to have him on the show. JC, welcome, my friend.
Thanks for having me. I appreciate it, Rod.
Absolutely. So let's talk about, the first thing I always like to get into is your background, how you got into this business. Most people are transplants from something else. Maybe you could speak to your history and how you ended up in this exciting business.
Yeah, absolutely. I've got a 15 plus year background in the semiconductor industry. Started buying and selling single family homes while I had a W-2 job back in the days. Made some money here in the Silicon Valley. And I decided to take that money after doing a lot of research and how to scale my real estate, decided to take it and get into multifamily. So, figured out that California wasn't the place for me because of the constraints on cash flow, went out of state. Found a great market in Texas, did a lot of research on Texas, started buying properties out there in 2007 with my own money, and it took off from there.
Okay. So like many people, you started in single family, myself included. And Texas, is this the Dallas-Fort Worth? Is that where you ended up, or all over the state?
Yeah, we've really focused on the Dallas-Fort Worth market for very specific reasons, and we've grown our footprint in there. In DFW over the last 12 years. That's right.
Okay. Well, I'll tell you what, let's dig into the specific reasons. Why do you love that market? Because I'm sure that'll add value.
Yeah, well, there's three big reasons, right? And all this comes down to doing a lot of research, but it's not all that unobvious to people that are seeing what's happening in the market. But number one is you've got huge population growth, okay? And population obviously drives apartment demand. Number two, you've got phenomenal job growth. Dallas-Fort Worth consistently ranks top notch for both job growth in the nation and population growth. And the third thing that I always like to talk about is really sort of I call it the quality of life per dollar earned. And I challenge anybody to go and find more of a better ratio of that combination than really in Dallas-Fort Worth and in Texas as a whole, right? So if you're looking in Texas, that's your market, you're going to think about the, Houston, Austin, San Antonio, DFW. Those are sort of your four majors. I went to DFW because I really like the diversity of the workforce, and the jobs were over there were across many different sectors. We all know Houston is oil, so that is good when it's good and bad when it's bad.
Okay,
that's the reason I went to DFW.
Now, you like the diversity of the population, income, and I guess just diversity in general. Do you focus on A assets, B assets, C assets, and what's your criteria there?
Well, we specialize in value add B and C class. We're not in the A space.
Okay.
C gives us the optimal ability to come in, take a property that's really got a few things wrong with it, but that fundamentally is in a great location and has good bones, if you will. And take that, renovate it, do some exterior work, spruce up the amenities, put an interior upgrade package on the property, and really look to push rents to what we feel would be an adequate market for return for those investments that we're making.
Okay. Let's go back to your first multifamily deal. How big was your first one?
Well, we actually bought two deals. We bought a 24-unit building and a 50-unit building from an owner directly.
Okay.
And it was sort of a fluke accident. I had actually targeted a property in Denison, which is right outside of Dallas-Fort Worth.
Okay.
And I had found a contractor to do the work. The deal in Denison fell apart. And as I was talking to the contractor, I was pretty bummed out. I said, look, we didn't get the deal. And he just happened to tell me, he says, well, you know what? I actually have two properties in Garland, Texas, right? Which is
that
right
the contractor owned himself?
The contractor himself outright owned two properties, and he was a painter and a rehabber and really, really busy, wasn't managing his properties the way he felt they could be. And I happened to mention it to him. He said he had deals. I said, look, I'd love to take a look at them. Long story short, made an offer. He accepted. and I bought those two properties just completely by accident. That's the way it happened.
That's fantastic. And that's really just out there networking, talking about the business. And in this case, you fell into that. So, um, uh, did you, I assume you didn't do seller financing or anything creative. You just went out and got financing for those first two. And when were those?
Yeah, they were traditional loans through Wells
Okay.
Fargo Bank.
Okay.
We wrote the deals and they underwrote really well, and they
Okay.
were quality assets, so the bank was happy to lend on them.
What year was that?
This was in 2007.
Oh,
So
wow.
we actually bought those two deals. We bought a third deal right before the market crashed.
Right.
So I think, a lot of people have been in this business, sort of over the last several years, but, I think riding a downturn is such an educational experience for everybody. That was an experience for me that was worth a lot of money back in the early days.
So let's talk about that, because I couldn't agree more. There are a lot of syndicators out there right now raising money on deals that have never experienced this. And frankly, and I did a whole segment on this, in that, passive investment is a great way to get started in this business if you want to be an active investor ultimately, but you still need to educate yourself, because there are some syndicators that have not gone through a downturn, that aren't stress testing the deals properly, that are rushing into deals. Sometimes I'm astounded at deals that we pass on, that at the price they trade for, and they're tight. And if there's a hiccup, these deals are going to have a problem, and the people that are going to suffer are the passive investors. So talk about some of the things that you experienced through the downturn, and how you were able to, and some of the things you had to do to make it through the downturn with your properties. Can you speak to that a little bit?
Well, absolutely. And first thing I'd say, Rod, is I completely agree with you. These days we're on the sidelines for the most part, and
Mm-hmm.
very opportunistic in this market. We are looking for reasons to say no to every single deal we see, and most deals are not deals these days. And so I would say to your base, your listener base, this is the time to be extra diligent, stick to your guns, stick to your underwriting parameters, and do not deviate in this market. Now, that's not to say there aren't great opportunities that come around. They're just way fewer and further between, and you really have to have the right relationships to find them. Now, back in the days when I bought those first three deals and the market crashed, I always got into this business with a long-term mindset. And what I would say to everybody is, look, living off of a 3 to 5 year flip and calculating your IRR based on that, everything looks great on paper. I always look to hold deals for 10 to 12 years. If I can sell them earlier and we can hit our numbers, great. But we're long-term guys. And so we're going to set everything up as if we're going to be in a deal for 10 to 12 years, including the way we look at financing, including the way we look at the property in terms of keeping it and making sure that all the deferred maintenance is there. So we start with that sort of a long-term mindset. Now, when 2007-8 hit, what I found out after going through the downturn was, the problem was that if you ran your property and you bought on sort of false numbers and pro forma projections that you couldn't hit, that's where people got into a lot of trouble. We always bought on real numbers. And so when the downturn hit, we had a great location, great property. We stayed full. We even managed to raise our rents. Now, the equity in our deal was a little shaky.
Right.
We picked up those deals back then at $26,000 a door, which I thought was a whole lot of money to pay for them.
Right.
And after the downturn, they probably worth maybe $20,000 to $25,000 on a really, really good day. So basically less than what we bought for them. We never panicked because our cash on cash returns were always just where we wanted them to be, over 10% for the entirety of the whole period until we sold them in 2015. So for us, I never worried about it, because the deals were winners to me because they were putting cash in my pocket. They relatively stayed full, between 90 to 95% occupied. And so I didn't really care about the equity piece. I figured eventually it would come back, and I was really looking at long term. So, the key is that after we rode the wave out in 2008, and let's say the market started to recover in sort of 2011, 12, really what we figured out when we looked back and did all the analysis was the equity piece can go up and down based on the market's going. But if you've done your numbers right, you should be able to make some sort of a minimal amount of cash flow return to sort of keep you going through that downturn. And that's really what you have to be prepared for, is how skinny can I get this deal and still keep it? And forget about the equity piece. You're not going to be able to sell it if the market takes a dump. You're not going to be able to sell it for another 5 to 10 years. Are you going to be okay in that meantime? That's what you need to worry about.
Right. So what's your break-even point? And is your debt position so that if what happens in 2008, like what happened with you, you talked about your values going way down, and you need to refinance, that's a bad day.
I mean, let's think about it, right? What the classic example of what happened is a lot of people that had deals had an expiration on their loan. They had to refinance. They were underwater, and the bank wouldn't lend them the same amount of money that they would have needed to keep the deal going. So they had to recapitalize.
Right.
But you've got all these people that are investing in these deals. You go ask them for $1 million in the middle of a recession. They're not giving you the money. The property was still cash flowing. It may not have been great, but it was still cash flowing. The bank took the property back, even though it was cash flowing, just because they ran out of room on the financing and they couldn't recapitalize.
That's a bad day.
Recapitalize, everything would have been fine.
Yeah, that's a bad day. When you've got a cash flowing asset that you can't refinance, I mean, man, oh man, that's bad. Well, and again, back to what I said, it's irrational exuberance again right now, and it's people that haven't gone through '08 that are out there, taking down large numbers of properties. And I got to tell you, when the music stops, and invariably let's just hope it's not as bad as it was in '08, God forbid. But that's my big fear. So let me ask you this. So as you said, you're looking at a lot of properties right now to try to find a deal. I mean, we wrote an LOI today. We did one a couple of days ago. They're still out there, but we're looking at a ton of deals right now. But let me back up here. Do you have a favorite failure that you experienced that sets you up for future success? Talk about a time you got your nose bloodied, and what the lesson was.
Well, we've gotten our nose bloodied more times than I can count. In fact, this year, it's been happening way more times than I even care to admit. I think the key with getting your nose bloodied is how do you fail? Because the key here is that we're all building relationships with the communities and the ecosystems that we're doing deals in. Okay. Every time we make an offer to a broker, the broker is looking not only whether we win, but also how we lose, meaning that if we lose in the right way, we're building credibility with the broker. And there always is going to be a next deal with that broker. And so we try to focus on always being people of our word and making sure that whatever we do it on time, and we do it without any sort of what I would call making the realtor's life difficult. You can still be a closer of deals, and realtors can still say, you know what, I don't think I want to work with that guy anymore because he made my life miserable. The best way we explain it is when we get into contract with you, if you're a broker, we want your deal with us to be on autopilot so you can go worry about all the other guys that are making the deals difficult. We're going to make your life simple. We're not going to ask a lot of questions. We've already done all our homework up front. And once we get into contract, our objective is not only to close on time, but to put the deal on autopilot for the broker. And that is where we really have made a great name for ourselves in the DFW market specifically.
Yeah, that's hugely important. That's hugely important. They need to know you close, that you don't retrade every deal and don't retrade. And typically, unless something really was misrepresented or misstated or discovered that was unknown, that you go to the closing table without any problems. So let me ask you this: what's the most challenging part of your role right now?
Well, I think easily the most challenging part of my role is, when I started the company, it was basically me and is my own dollars. And so as we've grown over the years, my challenge has moved from sort of the blocking and tackling of deal doing. And by the way, we're owner operators, so we actually own our own management company, so we're vertically integrated. But the challenge for me has become, how do we continue to find amazing talent and bring it into the company to sort of help us keep growing, but do that at a pace that isn't going to put an unnecessarily high burden on our payroll. Because the other thing I'm a big believer in this market is we've got to be light on the payroll, because a lot of times what happens with syndicators is they get so heavy with payroll that they've got to transact just to pay the bills.
Right.
And so we are very, very careful about making sure that we're lean and mean from a payroll perspective, so that we can sit in this market like we are doing and not really worry too much about having to do a deal just to turn keep the lights on, if you will.
No,
That's what
that's
I'm very, very careful about these days.
yeah. There are syndicators that are living, frankly, acquisition fee to acquisition fee, and they're not paying attention to the fundamentals. And I'm really glad that you brought that up, because that has not been mentioned here before. And it's funny. I have a mastermind. It's actually, we're meeting here next week in Vegas. There should be about $3 billion in assets there, and that's one of the things I'm going to be training is how to find the superstars, how to weed through them. And we've got a new personality profile that we're gonna share with our with the participants. But that is every business is nothing but people and systems, and you want to find the best people you possibly can, and it's hard, and you've got to have mechanisms to do that. So I'm looking forward to that presentation. But the thing you said about staying lean and mean right now, very, very important, very, very good advice. So let me ask you this: what words of wisdom would you share with an aspiring multifamily investor? Maybe somebody that's done some single family like you started. They know they want more. They know they deserve more, and they see that they can ramp much quicker with multifamily than they can in single family. And frankly, in my opinion, it's much safer, based on my personal experience in 2008. But what advice would you give that person?
Well, my advice has never changed. And if I look back at where I was in 2007, and I would say I was sort of in a similar boat. Now, I hope that if there is a correction, it's not anything like 2008, but I think that you absolutely have to look at the long-term picture of investing in real estate. Too many people are getting into this business now, and they want to be, flipping deals in a year or 2 years from now. I honestly do not think that that's the right approach, actually, in any market, be it up, down, sideways. I think you have to be committed to learning this craft and learning it and being a long-term investor who's looking at not the 3 to 5 year window, but looking at the 15 to 30-year window. That is the way that you're going to be successful in multifamily, because it trickles down to every facet of our business, including building relationships, yep, not focusing on deals. These days, I never worry about deals. I worry about relationships. My relationships these days deliver all the deals that I need at the price points that we need, and it's going to continue to do that. If you're just focused on deals, that could be a one and done scenario. And in this sort of a market at the peak, that absolutely is the wrong way to go.
Oh, that's fantastic advice. And it's the same thing I say from stage. Put on your long game hat, play this for the long game. It's a relationship business. It's a team sport. And these are lifelong relationships. This is not a get-rich-quick business. It's a become incredibly wealthy over time business if you take on that kind of a mindset. That's fantastic advice. And they've heard me say it. It's really great to have someone else say it and add credibility to it, because it's so absolutely
what
true.
I believe. So I'm not just saying it. It's
yeah, no question. So let me ask you this: if you go back in time, what would you tell your 20-year-old self? What might you do differently, knowing what you know now about this business?
Well, it's a little bit cliche these days, because a lot of people have read Robert Kiyosaki's Rich Dad, Poor Dad, but just like everybody else, that book really changed my life. If I look at where I was as a 20-year-old, getting ready to graduate out of college, and I wrote my goals down, I always have. One of my goals was to buy a home by the age of 25, and I did that. What I didn't realize back then as a 20-year-old, and I wish that I could tell myself this, is that, assets put money in your pocket, and liabilities take money out of your pocket, and a house is a liability. And as much as I love to own homes, and I own homes, and it's been great, and I'm not, saying that owning homes is a bad thing. What I am saying is that if you're going to be a young guy that wants to invest, or young gal for that matter, look to buy investment properties, and don't really be too stressed out about owning a home, because too many youngsters that get out of school say, oh, I've got to own a home. That's when I've made it. Well, I'm here to tell you that if you focus on investment real estate, that's where you're going to make it big time.
No question. Why do you think people fail to succeed in this business and give up?
I think the biggest reason why people fail in this business, and I mentioned it earlier, is because they don't understand that this business is a relationship business, just like any other business. And sometimes you have to put the relationship ahead of a deal.
Okay.
And if you're really committed to building good relationships. And you have to be a performer also, given, right? But I mean, the relationships are the things that are your gold. And I think that I've seen the people that I've seen that have failed are always looking for the quick buck. You know, for example, they're going to go to several different lenders and they're going to go any which way the wind blows, depending on whether they can get a small percentage break on the interest rate.
Right.
Not keeping in mind that the relationships are what's really going to drive multiple deals over multiple years. And if you become a guy that's always focused on price and not value, you get put into the bucket of guys that don't get the priority when it comes to getting deals done. So,
And that includes lenders. That includes, of course, lenders, like you just said. You brought it up for a reason. It's not just the brokers. It's the bankers and the lenders as well. It's the lending brokers as well. Yeah.
So that's what I think is the reason. Now, you know, people fail for a lot of other reasons, like not underwriting properly and all that stuff. But I'm talking about, you know, long term. What is the reason most people fail? I think it's really not focusing on the relationships and not being long term minded in this business.
What did you have to give up in your life to achieve the success that you've achieved? What did you have to sacrifice?
Well, you have to sacrifice your time, basically. When I started the business, I had a full-time job in the semiconductor field. It was a lot of work. I did this at nights and on weekends, and anytime I wasn't focused on my job, which was a lot of responsibility. And so for many years, I kind of burned the candle at both ends. But I always knew that I would get to the point where I would be able to leave my job. And once I did that, I could focus on one thing and I could have a lot more time to spend on the things that I really care about and love. And for me, that time came in about 2012. And I haven't looked back since. But before that, the sacrifice was really the time in sort of doing two things at once. And the reason I chose that approach was because I didn't want to take a lot of risk. I didn't want to just jump into multifamily and completely quit my job and everything, because I really wanted to make sure I had a stable base in case something went wrong and in case the market turned. And so,
how many doors did you have when you quit? Do you remember?
Probably around 400 doors. I mean, we bought and sold, but around 400 doors or so.
Well, so guys, I hope you're hearing that. Okay, full-time job, family. I'm assuming you had a family.
Yeah.
Family. Full-time job, got to 400 doors before he quit his job. So if that doesn't encourage you or inspire you, then go do something else, okay? Because that's a clue. That's what we call a clue. So, if you could mandate, this is a little off topic, but I'd love to get your opinion on this. You're a really smart guy. If you could mandate that schools taught something that they don't teach well now, what would that be?
How to build businesses.
Love it.
And it's funny that you mentioned that, because I've been thinking about a nonprofit myself. And in my nonprofit, if I could start something myself, and this is not something I'm joking about, is I would like to go around to high school age kids, maybe even younger, and start what I might want to term the lemonadestand.org. And my concept is pretty simple, is we've got to bring this down to a lemonade stand and bring it out to these younger folks and show them that they have the ability to not only get an education, because that's important, and I've got my degree, but figure out how to build businesses and figure out how financials work. How many people do you know, even with an MBA, that could tell you what the difference between a cash flow statement, a balance sheet, and an income statement are? I can tell you right now, there's not many. And that is an issue, in my opinion, in the United States.
No question. Absolutely no question. It's funny you use that as an example. I'm a big Tony Robbins fan. He brings a guy in named Keith Cunningham that uses a lemonade stand as an example to teach financials to aspiring business owners. And that's
funny. I had no idea. That's interesting.
Yeah, his name's Keith Cunningham. He's a super, super funny guy, and I should get him on the show. He's hilarious, but he's brilliant, and Tony uses him at his business mastery. But so I've got two more questions for you. One is, what's the best advice you've ever gotten? And the other is the antithesis. What's the worst advice you've ever gotten about this business? And I know I didn't prepare you for any of this, but you're reacting real good. You're
yeah. So the best advice I've ever gotten, I can tell you, it's really, really simple. And the guy that told me it is Paul Peebles.
Oh, that from Old Capital. Good guy. Yeah, he's spoken at my live events. Awesome.
Absolutely. He told me, 1,000 hell yeses don't make up for one oh shit.
I love it. I
Right?
love it. That's
You think
awesome.
about that. A
I
thousand
love it.
hell yeses don't make up for one oh shit. So it really is a beautiful statement. It just means, no matter how good things are going, one super extremely bad move, bad deal, bad something like that can really set you back so many years that you really have to be focused on not only maybe on the deals you do, but more importantly on the deals you don't.
No question. Very regularly, the best deal you ever did is the one you didn't do. It's just is avoiding that mistake because in the numbers that we're playing in, one mistake can be a deal breaker for a decade. It's really. No, I love that one. Okay, now what's the worst advice you've ever gotten?
The worst advice, gosh, man, I probably have selective amnesia on bad advice.
That's
But
good. That's fair enough. Fair
I'm
enough.
trying to think. I couldn't think of something that I've gotten bad advice and I've actually done it.
What book have you gifted the most to people you care about?
I obviously the Rich Dad Poor Dad book.
Sure.
That,
Okay. That's it. Okay. Yeah. All of his books are fantastic. Every one of Kiyosaki's books is great.
I love a lot of his books, but the books that actually interest me the most are that one and also and I'm
Cash Flow.
blank, but yes, thank you.
Cash Flow Quadrant. Yeah, those are the two premier ones. He also wrote Rich Kid, Poor Kid or something. Fantastic book about children and how they all have genius and some of his Rich Dad branded authors are great. I've had most of them on the show here as well. Ken McElroy's a fantastic guy.
Yeah, absolutely. I've read his books as well.
Yeah. Listen, thank you so much for being on the show, my friend. And guys, if you want to reach out to Jesse, his website is multifamilypropertygroup.com. And Jesse, you've added a ton of value, and I'm very grateful that you took your time to be on my show.
Thanks, Rod. I actually had a lot of fun. Thanks.
Awesome. All right, take care.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.